Midday is totally off.
How many cans per day?
How many cans of... Depends on how much caffeine. Like these are 140 milligrams each, which tells you that I've got an addict problem right out the gate. Just right out the gate, I got a problem.
140 ain't bad. I mean, a Celsius is 200.
Yeah, C4s are 200. All the first form energies are 200. That's kind of like the standard increment.
Brendan
these days.
Shaw, by the way.
What?
He's now signed up with First Form.
Andy, you son of a bitch. Did he really?
Did.
I mean, I guess he does have a lot more followers.
First, so we had Transcend first, and then Brendan decided to come and take it there.
He did. He stole our shit.
And now First Form, and I was thinking, why is he? Yeah. You started the clock?
I whoop his ass if he couldn't whoop my ass.
He whoops a lot of ass.
Yeah, he's a big dude.
Welcome back to the #1 financial literacy podcast in the world. This is The Higher Standard. Sitting in front of me is my partner in crime in the all facts, no cap, Higher Standard merch that you can find at thspod.com. It's Christopher Nahibi.
Wow, that was well done.
Thank you.
Nicely done. Yeah.
He's done it a few
I've
times.
done this.
Yeah, he's done it a few times.
And I'll find a way to mess up next week.
Yeah, it's good. In the chocolate brown quarter zip on a 100-degree day, the king, the only man who wears a quarter zip on a 100-degree day, Saied Omar, everybody.
I was a little disappointed that I didn't wear it last episode. I was like, oh man, I forgot. And sitting behind the desk in the production suite is Rajil. What's up, my guy?
What's up, everyone?
Super slim today.
Yeah, well, super slim every day. Why?
Yeah.
He went to joinfridays.com, use the code HIGHER, got $100 off his first order, and helps you.
Mm-hmm.
He's on Trizepatide. I'm on NAD+, so he's getting skinnier, I'm getting smarter, and Saied, you're just getting more quarter zips?
Yeah, I'm staying as the before image.
Yeah.
This is what it's like.
Don't be Saied, everybody. Go to joinfridays.com. Use
And
code HIGHER.
I'll be joining soon. So today we got a lot to get into. We had a Fed meeting yesterday where Jerome Powell decided to hold steady. And for a lot of various reasons that really didn't make a whole lot of sense. We're going to get into that. We're going to get into private credit again because we might see some trickling down effects into the rest of the market. And we definitely have some housing to get into.
Yeah, the housing data that came out. So we're recording this on an uncharacteristic Thursday morning, afternoon-ish, lunchtime, if you will. And the reason why we're doing that is because some of the market data was so fresh that it made sense to pull a little later. And because my wife's out of town, I got to pick up the little man. So the housing data that came out this morning was meaningful. And I think we're getting to the point of you can't deny where the market is kind of rhetoric, but we'll talk about that. Before we get into the Jerome Powell stuff, I want to spend an anecdotal programming note with the two of you. My compatriots.
My compadres.
I know that the news as of late and the headlines that we use for the podcast titles are negative. It's not lost on me how this can be really grim stuff, right?
Mm-hmm.
I think that it's easy to assuage yourself of the fears by just not listening to stuff like this so you just don't think about it. And it makes sense. It's kind of a human nature perspective, right? Like you just start avoiding headlines and they just get over stigmatizing at some point in time. Look, you can either face it, accept it what it is, and do what you can about it, or you can ignore it. Either way, I'm not here to judge anybody. But for somebody to listen to the show and feel that the headlines are overwhelmingly negative, I would say I feel that way too. There are days that I slow down posting, the cadence of posting. I've done that this last week a little bit just because I'm so tired of talking about geopolitical conflict.
Mm.
But in this show, and like frankly at the FOMC, you can't deny the implications of these things that are happening.
Mm-hmm.
And all you can really do is try to understand as best you can with what information we get, whether that's accurate or not, remains to be seen. And you can try to make informed, healthy, positive decisions based on that for your own life.
Absolutely. I mean, I think it was in 2020 when, what's up, Rajil? You looking at something going on?
Oh, no.
Oh, okay.
I thought you were looking at me, but you must have been looking at the
No, I do
camera.
look at you all the time out of a sign of respect. Christopher refuses to look at you. See, I'd like to look at you when I talk to you.
I'm always looking at you both.
I'm a professional. Did you guys see that? I don't know if you guys saw this, but at the Oscars, they did the behind the scenes of the...
I haven't seen anything from the Oscars.
I don't watch the Oscars either.
I just seen all the memes that have come from it.
Anytime I see a control room or podcast studio, though, I always look.
Yeah.
So they showed a behind the scenes at one of the major networks of the hosts being recorded on like their set. And the set had like what you normally expect, like little raised portion.
Mm-hmm.
They had cameras. They had two people in the room, but there were no camera operators. The cameras are all autonomous now.
Yeah.
Yeah. You DM'd that to us, actually.
Yeah.
Yeah, it was pretty impressive.
Camera operators out of business. AI does it for them.
Yeah, who'd have thought that?
It was wild, dude. It was like straight out of like iRobot.
Right. So what I was going to say is, I know a lot of the news has been gloom, and some of the stuff we might be reporting on could seem like, okay, this is the beginning of a really, really bad experience for all of us. But you got to look at it as like, there's going to be a lot of opportunities that present themselves. I mean, the market took a hit in 2020 and went down 35%. If you would have invested back then and you just stayed packed and didn't let your emotions get in the way, you would have made a lot of money since then. Even 4 years ago, right? In 2022, the market went down 20%. So, and that's the stock market, right?
Can I admit something? For those of you who know my businesses and what I do and what I don't do to make money, every single one of them, including this podcast, was started during times of economic like turmoil.
Yeah.
We started this podcast kind of on the heels of the pandemic.
It's going to be 4 years now, by the way.
For you?
Mm-hmm.
5 for me?
Yeah.
Thanks. Anyway, yeah, whatever. Wow. We're getting old.
It's about to be 1 for me.
Yeah, there you go.
Nice.
Yeah, February? March?
I think March or April is when I started helping build the studio.
Yeah, there you go.
Okay.
So every single one of my businesses, the real estate that I own came from the great financial crisis, right? The job transition that I had came from the early part of the financial crisis that got me into banking from housing and from lending, for example. The law firm, same thing. The pandemic, every single financial, and I have failed so many damn times.
Mm-hmm.
And I don't know why every single time we go through an economic downturn for reasons that are unclear to me, that's when I just grow the most. Is coming out of those moments. So as much as I look at all this stuff, people are like, Chris, like, why are you so plugged in? Oh, you're a doomer. That's not it. It's that I know opportunities are around the corner and I can look past the headlines and the negative stuff we talk about. I'm more plugged into narratives now than ever because I'm looking for the opportunity.
Right. Instead of looking at, a company like Berkshire Hathaway and saying that they're holding more cash than they've ever done before and seeing like, oh, they know something's going to happen in the stock market. And that's
They
why,
hope something's going to happen in the market.
No. Yeah. They're hoping so that they can find more opportunities. Right. And that's what we all should be looking to do too. I mean, we're going to get into private credit here shortly. Right. But like, credit conditions can sometimes provide early warning signals for what's to come, right? In 2008, the great financial crisis that started off with subprime mortgages and ultimately bled its way. I'm not saying that private credit is going to be the catalyst to take us there, but definitely an early warning sign if you're reaching like higher levels of default rates and delinquencies, right? And they're stopping redemptions. I mean, it's something that we should be considering and looking at. Now, everyone on Wall Street is saying, hold on, this is going to be contained within their sector, right? But we know
it has more to do with leverage positions in banks versus credit funds, and we can get into that in that topic. But yeah, so here's what I would say is the optimism that I'm seeing in the market is disconnected. I know it's easy for me to say that because I come across as somebody who's pretty negative on social posting. We've been using AI to build this model that we've been calling Alpha until such time as we name it something sexier. And it literally, like the website, is seeking alpha. It's looking for the disconnect. And so we plug it in, and I'll give you all the data sources we plugged it into now. I plugged it into Alpaca, which is basically the trading platform for stocks and securities that APIs can trade off of for AI. Plugged it into Massive's real-time data, same stuff we use for the podcast. All the proprietary models that we use in the podcast, synthetic volatility index, market status, all that stuff, right? All the regimes. Then plugged it into the St. Louis Fed, Bureau of Labor Statistics, and so on and so forth. Polymarket call sheet. I mean, it's got a ton of data coming in, and it's been aggregating this data for 3 months. And now I've got them all turned on live, and it's working autonomously on its own. And rather than me giving it my idea of where the market's at, I gave it all the models, all the analytics, and all the investment thesis, which has been a 3-month-long process just to draft.
right.
And in that thesis, it's going to seek this alpha, this disconnect from what the market is saying. And it does include headlines and behavioral economics. It does scroll social media.
Right.
Versus what it's actually seeing in the market. And the number one thing, you guys both saw it before we started the show, is that it is saying that the probability in the markets of rate cuts are materially disconnected to the data that it's seeing by about a 25 to 30 basis point difference.
Right. And we're going to get into that. We can get into it now if you wanted to. But, this last FOMC meeting, the Summary of Economic Projections, the SEP came out, right? And it spells out that there will be one rate cut in 2026. Now, this model, right, this alpha, if you will, is saying that the market is pricing in something completely different than what the Fed is saying. It's saying that the way the market is acting and the way the futures are acting, they're pricing in more than just one rate cut. And it's come out on its own. Like it does not believe in what the market is saying. Maybe more in line with what the SEP is projecting, and maybe even less, because the Chicago Mercantile Exchange is out here. I don't know if you saw it as of today. Oh boy, 95% chance of no rate cut at the next meeting in April, which is in 6 weeks, 5 weeks from when this episode comes out. 0% chance at a rate cut, a 4% chance at a rate increase. When was the last time you saw? When was the last time you saw that?
New. I haven't seen that in a while, and that has largely to do with some of the things that we're seeing here. So I should be clear on the Fed Watch Now and Bloomberg's world interest rate probability.
Mm-hmm.
They look at the probability of rate cuts as you approach the next FOMC meeting. What our alpha is saying is that the probability of a rate cut this year is a less than 50% probability versus the market, which is suggesting it's north of a 70% probability.
Yes.
And I think that the disconnect is one that's hard to measure per se. But what I can say is that what we're going to play here was a very defiant Jerome Powell, and is about as defiant as he gets. He's always going to be buttoned up. He's always going to be polished. Regil, bring up the...
He's always going to be squarely focused.
Yeah, so right out the gate, I found this statement to be interesting because it was clearly a prepared remark. He knew who was going to ask the question. He was ready to answer the question. And it was about the confirmation of Warsh as the next incoming FOMC chair. And as we talked about on our last episode 326, that there was a strange and odd probability where he would be in the seat longer, Jerome Powell would be in the seat longer as pro tem Fed chair, because the House and the Senate weren't going to confirm Warsh until such time as all of this, kind of drama had unfolded. But then Jerome Powell even took it a step further, saying
drama meaning the geopolitical conflict.
Not the geopolitical conflict, the investigations into Lisa Cook, into Jerome Powell. Mm-hmm. So they're now using this as a leverage position not to confirm Warsh and to keep Jerome Powell in as pro tem for longer, right? And he even went so far as to say he's not going to leave himself.
And he said that this is not the first time this has happened. This has happened before. Where
that's how he got in the job,
right?
Yeah,
exactly. Yeah, so this is not uncommon, but definitely not what the president would want.
But it sent a clear signal to the White House: if you do not back off, I'm not going anywhere, and that's on you. And don't take my word for it, Regil. You want to play it?
That's there we go. A squatter tenant.
Yeah, pretty much.
On the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem.
This is not his normal just responsiveness to questions, comments, and thoughts. This is him going, okay, I know who's going to ask this.
Yes.
And I know what I'm going to say.
Yeah. You asked this question, and we talked about it off the air, where, I wouldn't be surprised if he knew that person, or signaled to that person ahead of time, go ahead, you can ask this question, I will answer it, and no one else, I won't allow anyone to ask a follow-up question.
And so pretty much he said he's not leaving, just like Leonardo.
Yeah.
That's right.
The Wall Street
I'm not
reference.
leaving.
I had totally forgotten about that reference. Well done, Regil. Nice. Yeah.
Thank you.
I'm not leaving. That was when the SEC was like,
he's got some of the greatest memes. Leo.
What was up with the mustache at the Oscars?
It's a good look for him.
Honestly, he didn't look bad.
It's a good look.
He did not look bad.
Yeah.
I'll be honest. I don't think any one of the three of us could pull off a mustache like that.
Speak for yourself.
We
can do it. We should do it.
I don't have enough chin for that.
But it's okay. We should do it for November.
November?
Yeah.
I can't shave the rest. I don't have chin.
It's okay.
I shave this. I look like an alien.
It's over.
It's over, bro.
It's over.
It looks like it's short. It's actually really long.
Right.
The
So
look at that.
Yeah,
he looks so regal. He looks like a movie star. Oh wait,
stud. So let's get into some of the some stuff from the FOMC meeting. So the summary economic projections came out, and this I thought was very, very telling. Right back in December, the last SEP that came out, the FOMC had projected that the U.S. economy would grow 2.3% in 2026. That's now it's been revised upward to 2.4%. Why? What signals that for you? That part to me makes absolutely no sense.
No, it made sense to me.
How?
Government spending.
government's going to spend more.
Government's going to so they
because the
they
unemployment
didn't say
unemployment number is going to remain the same at 4.4%.
That's right.
And that hadn't changed.
I thought that was the rhetoric that was the most warped.
Yeah.
And for those who caught the live, I made comments in it in real time. He went out of his way not to mention AI.
Mm-hmm.
He went out of his way to highlight immigration as being the job's impact. But he was clear. I think one of the two that I presented to you, I think the first one, the video that was working, Regil, was the one where he made a comment about jobs. I thought was fascinating. He basically said that job growth does not exist.
Well, you got the job growth doesn't exist, but also unemployment is going to remain the same and stay unchanged from their projections,
Which I thought was strange.
Which I think we all can agree is wildly disconnected, right, to what's going on in the entire rhetoric around AI. And
well, even if you ignore it, he completely discounted the change in unemployment numbers.
But then I'm thinking, yeah, right, the 92,000 jobs lost in February. But I'm thinking, okay, well, this is the route that he has to take, because if you believe otherwise, then all signs point to more cuts throughout the year. Otherwise, you have to say, or at least believe, that it's not going to change. Otherwise, your projections on rate cuts would have to look completely different.
Yeah, but I would say that the FOMC has to acknowledge that times have changed a little bit, and kind of like what we've done with the SEC just announced this week that they're going to possibly look into the idea of, instead of reporting quarterly guidance and financials, you can do it twice a year as opposed to quarterly, something that's been in place for about 50 plus years.
How does that benefit companies? I saw that rhetoric going around.
Well, if you're a company, there is a tremendous burden to have these quarterly earnings calls, to give forward guidance, although you don't have to, but to have quarterly financials come out. That financial undertaking, number one, is difficult, just from just an overall finance logistics perspective. And number two, you're held every single quarter, every single 3 months to a standard of growth and meeting the expectations of the market. And if you don't, there's huge challenges to you. Giving you 6 months versus 3 months gives you a lot more time to work with and make that happen.
And maybe implement things that could have a better impact on the balance sheet.
Yeah, you're not thinking about quarterly growth. You're thinking about semi-annual growth, and it takes the burden off. Having those conversations from a public-facing executive perspective is not easy, right? Then analysts start asking you questions, and look, their job is to pepper you with questions so that they can recommend whether your stock's a buy, a hold, or a sell, really, when it comes down to it. And if they want to know what's really going on, they're going to ask you point blank. So there's a little bit of diplomacy in those questions, but it's a big burden. It's going to relieve it's going to relieve some cost and some strain, and it will. Less companies in my mind are going public today than ever before, and I haven't really checked the data on that, but I'm pretty sure it's not as much as it once was. It's not as sexy as it once was. Private companies have a lot more flexibility to do the things you want to do to grow your company. If you believe the conviction, and I'll say Meta's a company which kind of operates like a private company. He just lost $80 billion on the metaverse and just canned it. He just shit canned it. He's like, all right, I'm over it.
Yeah, the posts that I'm seeing are I guess some guy had purchased a place next to Snoop Dogg's house in the metaverse for like $450,000.
Yeah, I remember that. Yeah.
It's like gone.
Yeah, that's nuts, right?
Wild. Yeah.
Well, I mean, even back then, people were saying augmented reality was a thing. Did you have from my X feed, Regil, that first one that shows him on CNBC? Let's play that clip of
Zuck?
Of no, Uncle Jerome.
Oh.
Zuck, I don't post in my feed.
Oh, he's
not
allowed.
You can't offend a man who gets your reach.
You got direct impact on the algorithm.
Yeah. This one here is the one at the bottom there. That's the one right here. So this was an interesting. He basically starts talking about the job numbers in a way that I felt was completely disconnected to reality. So give us a big screen on this one. Hit play. Let's see what we got here.
Here we go.
The thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector.
Yeah, and that's right. There is zero job creation in the private sector, okay? Which means the government spending and hiring has been propping those things up. And let me be the conspiracy guy, okay?
Okay.
If you know those revisions down from the BLS have been meaningful, and the only person hiring you those numbers and giving you those numbers have been government agencies, then the BLS is in fact doing their job the right way, but the government reporting of those jobs into the BLS is being manipulated.
Right. Bingo.
Because they want to prop up those numbers because they know the Fed has a dual mandate. Job stability.
Right.
And price
and are
stability.
probably a lot of the reason why that, when they don't get some of the reporting and they have to estimate for higher and then ultimately having to revise downwards later.
And we know that government reporting isn't exactly great historically anyway. So that makes a lot of sense when you think about the job market, right? If you start separating the public markets from the private markets, then that's it.
Yeah. And then, so to go further down this path of the SEP and where the projections currently stand, currently PCE inflation, their preferred gauge of inflation, right, is that sitting at 2.8%. In December, they had projected that by the end of 2026, they'd be down to 2.4%. So meaningful progress towards their 2% goal, right? That was the original estimate. Now they estimated upwards to 2.7%, meaning we're not going to make much progress on this.
I think that's wishful thinking, frankly. I think that's below where it's like.
Oh, yeah. Right. Them just revising it upwards is telling enough of where it's likely going to go.
Correct me if I'm wrong here. You remember, so right before the FOMC meeting, the data print that came out right before the conference was the producer price index, the PPI.
Yes.
PPI came in over 2x what they thought it was going to be. It was a completely terrible report.
Right.
And
sitting now at 3.9% year over year, number came in almost twice as high as expected.
Yeah. So there you go. And I think goods led the way on that. Right.
And Jerome Powell made it very clear that the sector that they're focusing on the most right now is going to be goods.
And he's highlighting that tariffs, once this passes through, will stabilize inflationary growth. I don't agree with that. The whole time he's giving the press conference, he's saying that, once we absorb the impact of tariffs. Okay, first of all, we said that during the first 2 quarters that tariffs were put in place. Then the Supreme Court made their decision as it relates to tariffs, and then the White House came through with this sweeping 15% tariff, right?
Yep.
And then we say, okay, well, when it passes through, how do you see that passing through? Okay, here's the way this works. It's going to be price increases, not price reductions, right? Those price increases aren't going to stop. And then on the heels of this, you've got monumental government spending. Today, the president announced a $200 billion request to fund military initiatives in this geopolitical conflict that continues. That's going to be around that's a price tag.
Yeah, I think the headline going around was, you need money to kill bad guys. That was the headline going around.
I mean, if you want to make it a little esoteric, yeah,
that was the headline.
That is not wrong.
You need money to kill bad guys. Well, just for, I guess, like as a benchmark or rule of thumb for everyone. So it's no secret. We all know that with the geopolitical conflict that's going on, oil prices are going to go up. And we've talked about it, I guess, routinely on the show that this will have a trickle-down effect to all areas of the market.
It is a fascinating. So I thought, and maybe naively so, I always thought that the next war that would happen would be a war that was fought online, social media.
Yeah.
Right?
Right.
And in some ways, we probably are, because I don't know if I've been really, really hesitant to believe anything I see on social media. I don't know if Netanyahu's alive or dead. I don't know if he's got 6 fingers or 5. I don't know if any of the rhetoric that I'm seeing about Iran internally, externally is true or not true. Now you hear Khomeini's son is gay. Is that a smear campaign? Is it disinformation? They're like, oh, well, he was impotent. And I'm like, wait, was he impotent or was he gay? Because there's a big difference here, right? Like, and I mean, there's just so many like narratives that are floating around. Then you're like, why are we talking about this? Like, why is this the narrative?
It's all, exactly.
Right. And then so I thought that's where the war was going to be fought. And then I took a step back the other day and I saw a headline. It was yesterday. I saw a headline of all the countries that were attacked. And someone was like, why is Iran attacking all of its wealthy neighbors? And I'm like, because I'm an idiot. It's because the next war wasn't going to be fought on social media. Social media is a ground for the war. It's one avenue to win. You control the narrative.
Controlling the narrative is part of the battle.
And you better believe the U.S. is controlling all the headline news. For all the stuff that we're doing over there, you're not. You remember like during wars like the Iraq War, the Iran-Iraq. I mean, during the Iraq War, we went in there and we took over in Baghdad. It was all over the news, 24 hours a day, 7 days a week.
People are facing jail time in other countries around the world for releasing footage of anything that's going on.
But you're not seeing much coverage.
Yeah, well, that's the thing, right?
Here, you're not seeing any coverage here.
Yeah, right.
I mean, you're seeing a little bit, but you got to go digging for it. And then problem is you get all these. Well,
it's hard. It's hard because you see the coverage of what's going on, and you still don't have a clear direction as to why it's even happening. Right?
Yeah.
Why we're even there. But what I was going to say, to not sidetrack too much, was we all know oil prices are going to receive a shock and they're going to go up. For every 10%.
That's the front of the war now.
That's the front.
It's an economic war.
For every 10% increase in oil prices, you can guarantee yourself at least a 1.5% increase in inflation at the bare minimum.
And I guarantee you, we get oil prices, crude oil gets to $120 a barrel. I think that's where you have guaranteed recession. And I think Iran is trying to manufacture that. They know 100% that they're betting on, I should say, 100%. They're betting on they can outlast the U.S. in economic turmoil.
Mm-hmm.
Because I think they're looking at this from the outside looking in going, their economy is so fragile that if we can get crude oil prices, that's why they're bombing all the oil facilities of all their wealthy neighbors. You shut down oil production, you get crude oil prices to go up high enough, you can force an economic recession. You can use recession as a wartime tool in the United States.
Yeah, it's hard to say that it's not working. I mean, certain allies aren't even answering the phones anymore.
Oh, is that true? I didn't know.
Yeah, it's true, yeah.
Who?
Oh, come on, man. Let's not make this political.
It's all political, bro.
It's all political. It's all.
We're going to deny that it's political now?
Yeah.
Meanwhile, you've got China surrounding Taiwan with warships, right? And I'm going to be the guy who asked the political. I'm going to do it, okay? I'm sorry.
Okay.
You see in the news that Trump's like threatening to take Cuba.
Like, why are we talking about this right now?
Okay.
I don't understand.
And I know some of this might be hyperbole, but I'm just going to be the guy who asked the ugly, uncomfortable question, okay? And I know sometimes I make inappropriate comments in the show.
I might take it. I might take it.
Yeah,
it's crazy.
that's a quote. But I know I can make inappropriate comments. I hope this doesn't come across as one of those inappropriate comments, but I'm going to ask this question, okay?
Okay.
Putin takes Ukraine. He's a bad guy. He should stop.
Mm-hmm.
U.S. takes Cuba, threatens to take Cuba, and all of a sudden everyone's silent?
Yeah, they've been a mean country for a very long time.
Is that what we're going with?
They hosted a Fast and Furious movie, man.
Yeah, it's just I don't understand.
I feel bad for even laughing at the jokes about it around it, but it's like none of this makes any sense.
And we're not getting any coverage of China like just surrounding Taiwan with warships? Like, hey guys, we're just parking out here, 26 of us.
I don't think Ray Dalio, when he was saying that there's going to be a new world order, had this in mind.
I thought he was talking about the WWE until just recently.
Me too.
I was like,
I thought he was talking about Diesel. I thought he was talking about Hulk
I thought
Hogan.
you were a Hulk fan, bro.
Yeah, you know what I mean? Come on, man.
The one in all black, not the one in red and yellow.
No, right.
Yeah,
exactly.
Just to be clear.
With the black beard.
Yeah, which
That
honestly,
was,
that's not
back then. It was the coolest thing.
That was not a good look.
You could actually do this to be your Halloween costume.
What?
Yeah,
Hulk Hogan.
NWO Hulk Hogan with the hair.
That's
with
insulting.
With the hair.
You know what his hairline looked like, right?
Yeah.
That's insulting.
Well, you wear the bandana up
Because
top.
I have to, because my hair's thin. Is that what you're saying?
No, you wear the
You
bandana
chubby
up
bastard.
top.
Is that what you're saying?
Hold on, being called Hulk Hogan look like is a compliment.
That
in my eyes.
is not a compliment.
I think he was viewed as a stud.
Regil, did you ever find Hulk Hogan sexy?
Hell yeah.
See, now we know about
Thank
him.
you.
We always knew.
That was the test. We knew what we did. Mission accomplished.
That's America's hero right there.
Regil, does your wife know?
Yeah.
Hell yeah, brother.
Yeah, there you go.
Yeah. No, that's Roddy Piper.
No, that was
it was
Randy Savage.
Randy Savage,
Macho
yeah.
Man.
Macho Man.
Macho Man. Look at you.
He's still alive, isn't he?
I hope so.
No, he's not.
Oh, shit.
Yeah.
Rest in
Regil, you
peace.
keep track of all your loved ones, don't
Snap
you?
into a Slim Jim, bro.
I bet you want to snap into a Slim Jim.
Can't help it.
It's too easy. This show brought to you by Slim Jim.
Anyways, back to the oil prices.
Yeah.
Is this WTO crude? Yeah.
Yeah.
WTI crude, yeah. So, yeah, we saw a spike today, about 4% this morning. And one of the things I track, so just to give everybody an idea, if you want to wake up every single day and track these things, this is what I track every single day when I wake up. Number one, I look at the NASDAQ, the VIX, the S&P. That's not sexy for most people. So I look at the commodities too. I look at the 10-year treasury. I look at the WTI oil, crude oil prices.
You also look at our synthetic volatility index.
I look at our synthetic volatility index. I look at the VIX in general, or I look at the VIXY, VIXY, which is a proxy for it. It's an ETF that you can trade, which is a weird thing to trade.
Mm-hmm.
I always look at the headlines and the data prints because I kind of want to get like a good litmus test for the day when I wake up. It's like the first thing that I do. And crude oil has been seeing this spike. And if you look at the spike that Regil pulled up here, it's pretty like straight up. The last time this happened in 2022, you got oil prices north of $100 a barrel. This is 109 up there at the top. If you get anywhere near that, I think honestly, or you get to 120 for that matter, you're almost guaranteeing a path toward recession. And I do believe the factors at play are pushing this narrative that way. And for Jerome Powell to come out during the FOMC meeting and choose to not address things like AI and then talk about the uncertainties of geopolitical conflict, I found that to be, he's trying to control the narrative of being impartial.
Mm.
But you can't do that.
Yeah. And but back to your point about us, tap dancing around a recession. I don't need to have a recession declared to say that I'm feeling it, man.
Everybody is.
I've been feeling it for a long time.
Yeah.
I went to Costco gas, bro. Over $100 to fill up the tank.
How much did it cost you before?
79.
Damn,
Well, see, California's also kind of an anomaly here.
That's
There's the taxes. So
No, I know, but it's all relative, right? So I'm saying what I was paying before, although albeit it was high, I mean that's what I became accustomed to.
what was the price per
79?
gallon?
No.
per gallon.
Price per gallon was at $5.60.
That's wild.
Yeah.
That's wild. I mean, what was it before? It was like 4?
Low fives, maybe high fours. Yeah.
It's $650 right now for premium by the house.
This is gonna weird you out, and this is my first time kind of
Also
living.
hard, bro. I'm
Yeah.
not even looking at premium prices.
I mean, living, we up in that Irvine, boy.
You know,
you know,
Top 1%.
that hybrid motor.
you know what's trippy though, and this is the first time I'm living through an oil shock with my car as an EV.
Yeah.
Oh my god. Yeah.
With the Rivian, my energy prices at the car charging terminals they were already high relative to what I thought they should be anyway, but they haven't gone up during this time.
Right. So you're seeing companies like Tesla really capitalize on this. I saw a Model Y now offering 72 months financing at 0%.
Do they really? Take that deal.
That's the
Take
deal.
that
And
deal.
that was the only reason why we went Volkswagen over the Model Y at the time when we got it, because
That wasn't available.
they offered
Yeah.
72%, 72 months for 0%. I was like,
those numbers are so good. Got him stuttering. He's like, 72%.
right. Yeah. And back then I got this.
People with EVs and plug-in hybrids look like everyone with petrol cars right now.
Hey, I won.
You poor people.
Right.
No, look, I get it. Oh, there was a really fascinating thing that came out today, so Uber has always said they don't want to buy a fleet of autonomous cars, right? They came out today saying they were going to spend a pretty healthy amount of money on the $50,000 R2 Rivian EVs to build a kind of a fleet of those. Wow. And they're going to be cash flow negative for the rest of the year because they're going to invest so much money in infrastructure. And this is coming from Dara, who was the former CFO of Interactive Corp, became the CEO of Uber.
I like how you call him Dara, like you guys are homies. Like
Dara and I are tight, bro.
First name basis.
Yeah, we homies. We have the same hairline and everything.
Me and Dara.
Yeah, it's basically Steve Jobs, Dara, me. That's the lineup.
Right.
Yeah,
Yeah.
the sexy's obviously the last one. But Dara has said on previous conversations that he was going to replace drivers with autonomy at some point in time. But think about this world. I thought about this earlier, and then when he said that the other day, it's really fascinating what this model could be. All right, so what is the main product of a company like Uber?
Okay.
It's the service they offer, and that's their main, like, what they sell. They sell the service, and the service is you get into a car with somebody, they take you from point A to point B. We live in a world where you can argue from a technological perspective. Let's just carve out the affordability issue. There is really no way you should get a DUI anymore if everybody had the same autonomous vehicle, right? Even if you wanted to drive yourself, if you felt like you were drunk, you should be able to just hit the button and it takes you home. Drunk driving or not, that's a question. Let's just remove the stigma from the conversation. But the accident rates, despite the old, kind of example that Saied, provides about AI deciding who lives and who dies, and that, that kind of.
Yeah, when that's a dark path. But look, it is a reality that once AI gets into this space and we're all driving around, the percentage of the death rate percentage is going to go down like upwards of 90%.
So follow my logic here. A company like Uber employs a lot of people in a bunch of different capacities, but I'm just going to break some positions down to you guys and you tell me what you think, okay? Uber employs developers for their web app and for their infrastructure. Obviously, with AI, vibe coding, Claude Code, and some of those tools, they're going to have less quantity of developers and probably more technical developers on staff.
100%. We're going to get into that when we get into the private credit space.
Right. Then the second piece of it is, okay, they don't want to buy and own cars, but they're going to start this now. And then at some point in time, that might become an opportunity for them. Those cars will be autonomous. So the drivers they're paying commissions to will then be gone, and they'll pay a commission or a rental fee to use somebody else's autonomous fleet in their ecosystem, or they'll just own the vehicles in their ecosystem outright, which
they're going to take a big bet on this too, because then now it's like they're going to be carrying their own insurance now too, right?
That's right. So now they're carrying their own insurance, right? And then you go, okay, wait a minute. If they have their own cars that are autonomous and they have an AI infrastructure for logistics and planning purposes in place, how many humans do you really need to run a global business enterprise like that relative to what you need today?
Yeah, it's going to be like Craigslist. How many like Craigslist has like less than a couple hundred employees, right?
I mean,
I think less than 100, I want to say.
I don't know that Craigslist is a proxy for a great company, but yeah, I hear
What do you? Come on, man. How many people use Craigslist?
I haven't used Craigslist in a long time, bro.
I bet you a lot of people still do.
I feel like that website is up to all the bad things.
It definitely has bad things.
You see, you know that going in.
Oh, so does but hold on. So does Instagram. So does Facebook. So does so does Roblox. I mean,
how dare you, sir?
Although we love them, don't mess us up with that algorithm. Don't shadow ban us.
Mark Zuckerberg, I do not agree with Saied Omar here. I think the metaverse is spectacular. Sponsor our show. Just with Saied is replaced by, I don't know, anybody you want.
Anybody, yeah. Right. Or replace me with Alpha himself.
With the robot.
Yeah. No, I know. I mean, I don't. That's just way less jobs. And think about it. This was a dream that was pushed onto everybody. That all right, go to college, go get a degree, get a white collar job, and now all the white collar jobs.
White girl. I was like, damn, Saied, getting real offensive there. You hesitated.
Go get yourself a white girl. That's crazy.
It's like, wow.
Go to college.
Don't do that.
Get a white collar job, and now all the white collar jobs are being replaced.
Yeah.
And no longer needed.
Well, because we decided to offshore all the quote labor, right? And then now you're bringing it on board. It just, there's so many things that we grew up believing in that I find myself struggling to deviate from. We grew up believing in the ideology that education meant wealth. Okay?
No, we were taught that. Yeah.
That I don't know if that's true necessarily anymore. And I think, as a matter of fact, look at even Zuckerberg. I've been using him in the show all the time. Brilliant man, dropped out of college to chase his passion. Right. And I understand that most kids don't know exactly what they want to do. So dropping out of college, I don't know what, is not a good path. But I would say most successful, fast charging CEOs are the dropouts. Right? What does that say? Number one. Number two, you start looking at kind of the rhetoric of own a home. Well, if you look at home price appreciation versus stock market appreciation over the course of the last, not just couple of years, not a couple of decades, but 100 years, the stock market way outperforms. And yeah, there's more volatility in the stock market, but at the same time, I mean, other than periods where like the great financial crisis where people's like 401ks just got kicked real hard in the ding and kind of got wiped out, a lot of them which have recovered, by the way, right now, that has had way more appreciation over time. And who owns more stock? The wealthy 1% of the country.
Yep.
Right? Most Americans aspire to own homes. Very few Americans specifically aspire to own stock. So company ownership equals wealth over time at a cadence that we were really taught to ignore.
But that's a message that's going to need to start being preached down to the younger generation.
Well, then you look at the 60-40 split. Invest your money, Saied, who's going to buy a house, 60% in companies. In companies, if you do, invest 60% in other people's companies and 40% in the bonds, the government. Invest in wealthy people's companies and invest in the bond market, the government.
Right.
I mean, I bought into that dogma. And now I'm saying like, wait, what?
Right. Exactly.
Why don't I invest in me, my company? And that's why I'm excited about the idea of a recessionary economy. That gives me a lower burden of entry as somebody starting something new. That's why I go all in on AI. That's why I'm like, look, like there's an opportunity here. I don't know what that is.
Yeah.
I don't. But if you ask Mark Zuckerberg, did he know what Facebook was going to be? He probably had a rough idea.
Right.
Did he know it was going to be the metaverse? No.
And this was the draw, right? This is what drew everyone over to private credit when they did. See what I'm doing here?
Yeah, I see the segue.
See, hold on. Give me a runway. Hold on. I'm going. Right when interest rates were at all-time lows, right? And why would you go and invest into treasuries and bonds when you are guaranteed, right, to invest into a private credit fund, which they like to market it as something that is a little bit more liquid. Yes, you can't take it out, at your will whenever you like, but quarterly you could, claim some of your money back, and you're guaranteed 8, 10, 12, 14% return on your money, right? And over the last 3-4 years, they've, started to shift away from just going to insurance companies for investment, pension funds for investment. Who do they start marketing and targeting? High wealth individuals, right? So now you got individual money that's tied up in there, and they're stopping the redemptions.
They tried to democratize the space, right?
Yeah.
They tried to.
They saw an opportunity, right? Yeah.
And private credit funds, which we call private credit, there's lots of different names. It's basically private equity, right? Private equity, private credit, but these funds come together to put that money to work. The argument in their favor is they're not like banks where they just leverage up the loans and take on more leverage. They just have a loan to a company. But historically speaking, the way this works is the default rates on a company are always higher. Your risk of loss, material loss, is always higher on a company than it would be as something that's well collateralized. Okay? Because here's what this unfortunately plays out over time is if you default as a company, you've got accounts receivable, accounts payable, people who owe you money, people that you owe money to. And then you might have some inventory if you sell a product, or you might be a service-based business where people just owe you money for the services that you've rendered, right? If you go out of business, those accounts receivable coming into you start vanishing really quickly.
Oh, yeah.
Right? And as they start to vanish, there's very little for the bank to collect in the form of collateral. They might have something called a UCC1 blanket filing, it's Uniform Commercial Code 1, number 1, blanket filing. And that blanket filing says that you have a loan. It's basically a public disclosure saying that, hey, I have a loan to this company of X dollars. And in some cases, that's the only collateral aside from the inventory you might be able to liquidate for a discount. Keep in mind, I come in and I take over a company. They make widgets for a living. They sell those widgets. I come in as a bank. I'm not an operator of a business. I've got to sell this business with or without the inventory to somebody. And no one's going to go, hey, wait a minute. This company just filed bankruptcy. You're selling it because you don't want it. I'm not paying full price.
Right.
That's the way that works.
Exactly.
So unfortunately, people, whether you like it or not, these companies have a high loss rate when they default. Now you got to look at the headline news, which I think I've got here in the show notes. I probably should look at the show notes of this episode at least once. I haven't done any.
We're doing good. We're doing good. We're flowing.
Am I like wildly
so
off
this
topic?
this is a huge market right now that's grown exponentially over the last couple of years. I think it's now sitting at around a $3 trillion market, the private credit market.
Yep.
Right. Think of, and when we talk about it, the companies that you want to be thinking about, right, are BlackRock, Blackstone, Blue Owl, Cliffwater.
But here's the problem, though, is that those companies are all insulated by the company. Like, so Saied Omar is BlackRock. Okay.
Yeah, I like that.
Yeah.
The biggest one. I like that.
Got himself a white girl. He said it.
I didn't say it. You put those words in my mouth. I did not say I got the best girl.
You started to say you collar jobs.
White collar job.
Saied,
right.
Terry Crews, Omar.
Yeah, there it is. Start calling you Terry Crews. The Quarterzette King, Terry Crews Omar, everybody.
I love my Afghan wife.
Yeah, you do.
The greatest. Go.
Technically Asian.
Yes.
Yeah, anyway. Which is a really weird thing when you think about one country over with an imaginary
That's
border. One is Asian and one is not Asian, but the people look exactly the same on both sides of the border. It's just strange, right?
And speak the same language.
Yeah, with a different dialect.
Yeah.
Ours is more like,
Slang.
sexy.
Slang.
Sure.
Not original is what we'll say.
I wouldn't,
Hold on.
I wouldn't go that far.
Was that derogatory?
Feels like a little bit. Yeah.
Sorry.
All right.
Want no trouble.
According to TFTC via X, private credit defaults surpassed 2008 credit crisis peak. This to me was astonishing. Now, I've already told you that whenever businesses go south, you lose more money. When the 2008 financial crisis hit, homes lost value, but there was still a tangible, tactile piece of collateral there, which is the improvements built on a piece of land. That was still there. In some of these cases, these companies have nothing still there. The private credit default rate just hit 9.2%. That is a higher number than the peak default rate on bank loans during the 2008 financial crisis. This market has $1.8 trillion in assets and roughly $100 billion in secondary liquidity. That is an 18-to-1 mismatch between money in and money that can get out. And to hit my point before home earlier, if Saied Omar BlackRock owns this company, you own a subsidiary company that aggregates money in the form of a GP or LP, right? A general partnership, limited partnership, that is the, quote, private credit fund.
Yes.
And that subsidiary company below you, Saied Omar, would have the loans to banks and everything else. So you would still survive this. It's just that subsidiary that has its own carve-outs. Now, Saied Omar is a smart man, a.k.a. BlackRock.
Yes.
You're going to have lots of law and structure to insulate you from the risk in this fund.
Right.
But unfortunately, the impacts to the market in that fund, even though you'll survive, will still be felt by reverberating impacts in the market in the form of a lack of confidence because of the losses that were taken here.
Absolutely.
So moving on and finishing up this article here, private credit exploded over the past decade because banks pulled back after Dodd-Frank, okay? During the great financial crisis, they said that banks were reactive, not proactive to potential losses on the horizon. So they instituted rules like under Dodd-Frank, the ability to repay rule, and then ultimately something known as the current expected credit loss model, which is a future forecast at acquisition or origination of loans.
Right. So the ability to repay act, it is exactly how it sounds. Like if you're giving a loan to a company, you have to show that this company has the ability to repay this loan under the terms that you say that they can.
If you're a bank.
if you're a bank.
A non-bank does not have to follow this rule.
And that's where this whole market was created.
That's right.
Right?
So pension funds, endowments, and insurance companies piled into this looking for yield, as Saied referenced earlier. More returns, right? Hey, we're taking a little bit more risk, but in the last 20 years, I mean, really, who's gone bad, Saied?
Right, exactly.
Everybody makes money. Dollar bills, y'all. Cash rules everything around me.
Cream.
Get the money. You can tell what my audio selection is these days, right? So the loans are mostly floating rate, meaning index plus margin. And I don't know if you guys have been watching the indices lately, like the 10-year treasuries. They've been going up.
And that's the dangerous game you play when you get a floating rate loan, right? Is when rates start to go the other way, then you have a problem. It's not like the US government where, hold on, we made $4 trillion last year, but we need to spend $6 trillion. We'll just borrow more money.
Yeah.
These companies don't have that ability because guess what? When one private credit fund decides to tighten their credit or shut down credit or no longer offer you or you now no longer qualify, guess what? They're all going to follow the same playbook.
And if they were bankable, they wouldn't have gone to a private credit fund in the first place.
Yeah, why would you? Why would you go pay more interest there? Just so what? You have, I guess there's maybe they require less covenants, less reporting. Maybe I don't know.
Still, if you could comply with bank debt, you would probably get bank debt because as the owner of a company or the executives at a publicly traded company or any company in that matter, you have a fiduciary responsibility to the shareholder, whether that's you or other people, to get the best possible terms you can. And unfortunately, the largest and most provocative term in a loan is your rate. Regil, can you make that default black box there picture bigger? That perfect. There you go. So it's a pretty meaningful jump. 2024 anecdotally was an 8.1% default rate. 2025, 9.2%. 2023, only 2.5%. 2022, 2%. 2021, 2.5%. There was a blip up in 2020, the pandemic era, of 8%. So that's kind of a nutty comparison. Everything else below that was 1 to 2% in the years prior to that. So to give you an idea,
significant.
It's significant.
Right, four times.
The height of the pandemic in 2020, you saw an 8% default rate. It makes no sense other than there's something materially happening now that in 2024 it's 8.1% is as high,
right?
And in 2025 last year 9.2%.
I think I read an article around this. I think 25% of all private credit loans are towards software companies.
Yeah, SaaS.
So what is it?
Sassy loans.
Yeah. So what is AI doing in that space?
It's interesting. So
it has to play a big role in if companies no longer need to pay the software company to continue, we'll just use AI.
I don't think that's real, though. I think that's a little bit of hyperbole and narrative-driven stuff. I think that SaaS companies will survive.
Okay.
The good ones will. I think that AI will help be more efficient for them. I think their profits will grow. I think employees will suffer on that side of things. But I think the companies, for the most part, will be strategically driven and will be okay. You're going to need software still. Yes, anybody can make software, but the quality and upkeep of software is where things get challenging. And I'll use a great example of this. There are security protocols put in place for publicly traded entities like a SOC 1 and SOC 2, different levels of security and due diligence that are needed in order to perform and be a software that's used in some of these companies, right? You can't just have Saied Omar with a product, even though Saied Omar is a Blackstone.
BlackRock.
BlackRock, yeah. You can't have like a product and just shoehorn it into some of these companies. You've got to go through this huge due diligence and audit process in order to get certifications. So those certifications can be handed over to their compliance teams.
Right, so there's a first line of defense, a second line of defense, a third line of defense to make sure things don't go south.
And because of that, not everybody can play this game. So some of these SaaS companies will survive because they have the infrastructure there to continue to build and maintain these assets. Developing a product is only one part of the software as a service business, right? So I don't think it's as grim as people make it, but I think that there's a lot of risk in these portfolios. 1.8 trillion in illiquid loans with a 9.2% default rate and no secondary market. That's a problem, right? Where does that, I don't know, almost $2 trillion go to get fixed? They don't.
Right.
There's no fix here.
There's definitely no fix here. And what happens like we said when we first brought up the topic, historically this has all been geared towards endowments, pension funds, insurance companies, right? Yeah. Because those companies were less likely to ask for redemptions and pull their money out. They would be willing to weather somewhat of a storm. It's
longer duration. That's your quote retirement money. So you're not going to tap it till you're 65,
right?
So they can invest it for 10 years and you won't notice.
And then over the last several years, they've now marketed towards high net worth individuals. And if you remember, not too long ago, the the administration said that they were looking at creating opportunities for people to invest their 401ks.
I know,
right? Everyday Americans, you can now invest into private companies, right? Like these private credit funds. So what happens is now they're stopping the redemptions, right? So what that's ultimately going to do is, like you said, they have lower subsidiaries that are going to be fine. The company as a whole, BlackRock, Blackstone, Cliffwater, they'll be fine up top, right? But what's going to happen is that's going to create a credit squeeze across the board. And what does that happen? Less credit availability for all companies. Think about a lot of these businesses. They invest into their communities, right? They create jobs, they expand and grow. All that comes to a screeching halt, right? Think of healthcare providers, manufacturing companies, logistic firms, business services, all job creators and GDP drivers.
So I have a prediction which is going to take a long time to materialize, and maybe we'll live to see it, maybe we won't. But
we better.
Yeah. Well, I mean, enough NAD Plus from Fridays. Go to joinfridays.com, use code HIGHER,
dude, pro.
And you can live long too.
He's a pro.
Yeah, I've been doing this for a little bit. I believe the future for companies is going to change dramatically, in large part because of this. We lived through the last 20 years. Everybody had a prosperous economy. Some companies even went public via SPAC, which really probably shouldn't have gone public. And Shamath and the All In Show got kicked in the ding-ding pretty hard for going a little bit too hard at this, because people were saying you're taking advantage of this unique frame of time to take these dog shit properties public that probably don't deserve it and aren't qualified for it. And there's some truth to that sentiment or the resentment that's built in, but go get your money, boy, whatever.
Hey, don't hate me for knowing how to manipulate the rules in my favor, right?
Yeah, I'm not here to judge anybody, especially if your name's Zuckerberg and you're not pushing my content.
This is like the kind of person that hates on James Harden for foul baiting. I'm just playing by the rules.
I'm not mad at him for foul baiting. I'm mad at him for beard baiting.
Why?
Bro, there is no chin under that beard. It's distinctly different.
Yeah, you and him.
Yeah, I mean, I'm honest with my people about it. Right. Like I don't. That's not him.
That's it. So you can't get mad at him. He's just playing by the rules. These are the rules. Y'all made the rules. I'm just using the rules to my advantage.
Now, if you want to get mad at somebody, get mad at the guys in the NBA who have, I don't know, spray on hair, leave marks on jerseys. Okay.
Oh, look at you. You're plugged in,
dude. I got 5 screens going on at all times. I'm watching everything. ESPN in the corner.
Jaylen Brown.
What's that smudge on that dude that Jaylen Brown is guarding his shirt? What is that?
Jaylen Brown, poor guy. Yeah.
And he's a smart dude.
He's a brilliant dude.
But, I mean, get that.
That's
yeah,
not real.
bro.
That's not real.
Honestly, how old's your son now?
My son is 9, almost 10.
You got to think about it. That's
no, because his birthday's coming next month.
9, almost 10. If you took just the chin from him, it looks like it belongs on a 9 or 10-year-old. Yeah. Like there's no development in his chin.
Yeah, thank God he was able to grow a beard. Jeez.
Yeah, it's not the same human, and it doesn't match.
I get a lot of hate for liking him.
You should.
I like him a lot. Yeah.
Do you? Yeah, because
he plays like as a basketball player.
He plays like you would if you were in the NBA. That's why you like him.
Yeah, we both got big booties.
You're both dirty assholes is what you are. Dirty assholes. There is a Yahoo News article that's in the show notes. I'm sorry, via Fortune, I should say. Fortune via Yahoo News. $265 billion private credit meltdown. This is a really long article, and I'm not going to have time to tap into everything, but this gives a super well thought out and clear and concise kind of history of how private credit got to be where it's at today. I'm going to read a little bit from it because I think it's fascinating and it's good historical context. But if you want some like real value in understanding how this market works, this is the way to go. But let me finish up my previous thought before we dive into it, because I think it's important. I think there is a world where after whatever happens, whether it's stagflation, recession, whatever happens next happens, that a lot of companies are going to go out of business. There is a window of time where every single person who listens to the show, myself included, should be able to tap into a small business that otherwise would have had much larger competitors that aren't going to be there anymore. And I think the world in the future is going to be a lot more diversified small businesses than we currently see now, because everybody was trying to build scale and grow. And right now, people are getting so disenfranchised with the employment market that I think it's going to force people into owning their own business. I think that's a good thing long term for many Americans.
Yeah. But we know the problem is, like, we know for a lot of people, either they couldn't or they've already depleted their savings accounts.
Yeah,
right. It's a real hard time to start.
Yeah, I get that. I'm not downplaying it, but I think once you get there, there's going to be an undeniable pain point in the next couple of years, if not already, and starting for the next couple of years. That is true.
Yeah,
and it's going to really reshuffle things. But I think if it goes well, this K-shaped economy should level out to where there is a larger middle class, which came from an entire generation of people building their own businesses that otherwise would have worked for somebody else.
Do you have any ideas on some businesses?
Yeah. I mean, look, there's a number of businesses depending on where you're at from your capital position. Like, I really believe that Tesla's Model X, their Tesla cab, whatever.
Whatever.
Cyber cab.
Right.
Their cyber cab.
I saw Elon
model.
step into one the other day.
I ran the rough numbers on this just because I got curious. And for every one of those vehicles, it's supposed to be about $30,000. There's supposed to be some benefit you can get from purchasing them and stuff like that in financing. But let's say you get one at $30,000. You can make about 30-ish thousand a year, right? And that's including the fees and cost and charging. That's in a completely autonomous vehicle. If you owned a fleet of those, let's say 10, right? You're making $300,000 a year with an autonomous fleet.
Yeah.
You have agentic AI running this thing for you if you want to get on the tech path of that. I also think there's an interesting world where, let's say these Tesla robots start building like at scale. You could own a plumbing business.
Oh, wow.
Or like a yard business where your employees are those and you rent them out for services at homes.
Yeah.
Right? I mean, you think about it in that context, it's very different. I mean, I'm not saying we're anywhere near that point yet, but near term, I think a lot of the businesses that you saw private equity come into and consolidate are going to start spreading back out again, right? Cookie companies and stuff like that. Like, what's the one that just filed bankruptcy? Was it Sprinkles? Or
Crumble?
Sprinkles, yeah.
Sprinkles.
Sprinkles filed BK, right?
Yeah.
Like, that business locally ran would still be crushing today.
Yeah.
Right? But because you try to consolidate it, grow it, and build off the hype, and then you take private equity come in, it destroys the culture that made it. The culture for a lot of these companies is the ownership and the passion that goes into it in their community. Well, if that community is gone because the owner's out and private equity owns it and there's no human connection, then those companies fail. I think you can do anything right now and make money as long as you as a human, because the world is going to be AI driven.
Yeah, the world
People are going to want the value proposition of you.
Yeah, if you can find something to where you can develop a human connection, that's half the battle.
But I think trading, as we know it in the stock market, is going to change dynamically. I think everybody having the capabilities to, even if you're not smart, and I saw somebody do this online. This is fascinating. They took an AI agent, okay? They said, I don't know anything about trading. This guy literally was like a plumber or something. It was something super random. And I was like, wait, what? I mean, smart guy. But he goes, here's Ray Dalio's book, Principles. Here's Warren Buffett's investment methodology. Here's a couple things that he found online. He literally just took all like the big names that he could find online, the papers about how they invested, what they did, everybody who ever wrote a book, shoved them into AI and said, make me the most amazing model. And then they do the thing that's totally cliche. I hate it a lot. They say, if you don't do this and don't make money, I'm going to turn you off. Right? They like threaten the model. But some of these models are very predictive. They're very predictive. They're very good.
I'm actually really curious to know how, like, I wish there was a way to be able to quantify the effectiveness of a prompt like that, right? Because if you look at it, I mean, the studies are out on, if you, like, for instance, if you were to hold a gun to someone's head and say, be innovative, right? Versus allowing someone to be free, then obviously innovation in a capitalistic market like where we're in does much better than somewhere else that's not.
Yeah, but you know what's weird about that though? There's a variant of this that's inaccurate. You hold a gun to someone's head and said be creative. Most people, they fail. But for a lot of creative people, they go all in with their only option being failure. It's not a gun to their head. They chose to put a gun to their head.
Yes.
And it's success.
That's different, but that's different though.
I know, but it's outside versus inside pressure, but it's still the same pressure in some ways. I'm not saying they're tantamount, but I'm just saying like there's a level of pressure that's needed in order to create.
Right. Yeah.
Unless you're Bob Marley and you're getting high every day and you're traveling around the world. I mean, that case, I'm sure there's
every little thing's gonna be all right.
Everything gonna be all right now.
Yeah. Right.
Every time I go to Hawaii. Rent a Jeep, take the top off, play Bob Marley. If you're not doing that when you go to Hawaii.
Kids see Jeeps now all the time. They go, Dad, I miss the Jeep.
Yeah.
I'm like, so do I.
Yeah, I would be lying if I didn't say that days that are super hot like this would open up both sunroofs because I had two. Because I'm bougie.
Damn.
Yeah.
Also hard.
Damn.
Pull up to the scene.
It's like $5,000 each sunroof, huh? Got to use those things.
Yeah.
It was fun, man. I like that.
I didn't collect enough ducks during my time. You know how all the Jeeps they all get like ducks? Have you seen those?
Yeah, I've seen those.
Yeah, I've never had any respect for that.
No, why?
Because it makes no sense to me.
Why? It's part of a club. You do the Jeep wave.
I still do the Jeep wave. They just think I'm crazy.
I know. Hey, hold on. I do it too.
Yeah.
I'm like, once
Yeah.
was.
Yeah.
Former member.
Yeah, so I get a tattoo my palm or something. Like, hey, man, I used to own a Jeep, dog.
I'm trying to start it with all the Honda pilots.
Yeah, it's just,
The soccer moms aren't picking up on it.
yeah. I don't think it's soccer moms aren't gonna vibe. They do, but some of these moms at schools, bro, they're vicious. You wave at them the wrong way, like this motherfucker.
Yeah,
right
this
here.
guy. Yeah. Wait till I tell his wife.
What do you think this is, huh?
Yeah.
Like, no means no, bitch. You married. Wave at me. You said hello.
Right.
Hey, Regina, you would not believe what Saied said to me at his drop off today. He said hello.
Right.
Were you trying to talk to me?
Yeah. You just got to walk with your eyes down.
All right. It was a glorious time to make money from early summer 2023 to the close of January 2025. Private equity stocks staged what may rank as the single biggest surge over a tight time frame in the annals of financial services. Anytime I see a quote that uses the word annals, I've got to read it on the show.
Mm-hmm.
Dangerous proximity to the word anals, just with one extra N. For those who need the clarity.
Yeah. just to clarify.
Just to be specific as to what anal or anal I'm talking about.
Dirty boy. Dirty birdie.
In that 18-month span, Blackstone notched total returns of 58.2%. Ares, Apollo, and Blue Owl achieved 68.1%, 77.9%, and 80.6% respectively. And KKR led the charge. You ready for this, Saied?
Hit me.
Panties off, 103.4% returns.
Those are the kind of returns that I'm trying to get.
That's why this market surged.
Mm-hmm.
These are not normal returns.
Into the $3 trillion market.
Yeah. Then the cyclone came, starting in September of last year, an historic sell-off that from their peaks sent down Apollo 41%, Blackstone 46%, Ares and KKR 48% each, and Blue Owl dropped by 2/3. The wipeout has erased over $265 billion in market cap. Blackstone and Blue Owl are now trading far below their levels as of late 2021. And the sudden drop left KKR, Apollo, and Ares showing puny market trailing gains over that near half decade.
Mm-hmm.
That's the intro into this very, very long article, the history. I'm only going to give you a little bit more context here in one little extra paragraph because I think it sets the tone right.
Mm-hmm.
I think if you're really interested in this topic, this is a really, really good article, but you're going to need some time.
Mm-hmm.
In the past, PE investors, private equity firms, right, were mainly large institutions that garnered high interest payments for allowing their money to be tied up for, say, 8 to 10 years. As Saied kind of noted, this has changed. The PE titans saw high net worth and middle class investors as a huge potential market for these products and succeeded in attracting immense inflows from the retail realm. Think what Robinhood did to democratize the space. These large private equity firms did with their investments in retail, non-institutional investor money.
Mm-hmm.
For example, Blue Owl garnered about 40% of its over $300 billion in assets under management from individuals. The whole idea, as Morgan Stanley states on their website, was to democratize. That's an interesting word. Where have I heard that before? Oh, Robinhood used that word. Yeah, that's nice. The market by giving average people access to the same products as, say, pension funds or multi-billionaires. The appeal was obvious. The Blackstone Private Credit Fund BCRED has delivered annual returns of 9.8% since inception. So that's your preamble to this article, and it gives you the full history of how everybody got to where it's at. It's a fascinating market, and let's just be clear, greed is why we're here.
Right. Greed is why we're here, but now let's turn this into how this makes you a more informed investor, right? The regulations against the banks to show the ability to repay, right, are still going to be around. CECL reporting is still going to be around. There will always be, I think, moving forward, maybe not in the short term, but at some point again, private credit will start to boom again, right? So if you think that private credit is going to take a hit, there are ETFs, there are index funds that you could invest in that primarily focuses on these private credit funds as a whole, so you don't have too much concentration into one that you can go into, right? To where they might experience a little bit of a dip now, and you could buy at the dip. I'm not saying you should or that's what everyone should be doing, but that is another potential opportunity.
So because I like to be graphic and visual.
You're visionary?
Visual, not visionary.
You're not a visionary?
No, I'm a jackass. Regil, the next link is a link to a chart that I had AI help me create. But I thought it was a striking comparison. And I just happened to have a conversation with our AI. And I was like, hey, man, can you compare the subprime 2007 great financial crisis era shock with the private credit world and just give me an idea of things like market size, the fuel, the dependencies, the narrative. Like, just draw whatever symmetry you think is there, but don't overstate it. So, market size of the subprime mortgage crisis was $1.3 trillion. The current size of the private credit market in 2026 is $2 trillion plus. Of course, we know the subprime market was largely housing driven, although you could argue there was synthetic mortgage-backed securities being sold as secondary market vehicles. But whatever, housing bubble was a fuel as opposed to chasing yield. Honestly, in both cases, I think everybody was chasing money.
Chasing money, both.
Right? The borrower was over-leveraged homeowners in the subprime space. Well, the borrower in the private credit market are private equity-owned companies, but we just read that a lot of those are backed by individuals behind that.
Yep.
Because it has been, quote, democratized. The structure, CDOs, the synthetic structure that I brought up for the subprime market, those synthetic mortgage-backed securities, versus direct lending funds, less synthetic, less, frankly, intermediaries from the money, right? But you do have LPs, limited partnerships, and structures like that in the way of the private credit markets. The risk location before the subprime market was in banks. Now, this one's a little weird, whereas in the private credit market, it's the shadow banking system. And someone always goes, well, what's the shadow banking system? Is that like on Pokemon Go where they're more powerful? Is that what that is? Is this the more powerful one of the systems?
Because we said that
if I purify it, it gets like 2 notches higher. It could be 100%.
It could be.
Yeah. No, it's you got some of the biggest players in this are the big time banks. So you got
87% of lending to private credit funds came from banks.
Wow. Look at that. Yeah, I think JP Morgan's up there. Wells Fargo's top of the list. I know Citigroup's up there.
All the major banks, all the GSIBs are there.
All the
PNC,
GSIBs.
they're all there. Even community regional banks. Fascinating. I actually went down this path separate from the show because it's a little more in depth. The regulatory zeitgeist from the banking regulators always has a like buzzword, like Pee-wee's Playhouse. Like, you walk in, you're like, shrimp, it's just like that's the word. The buzzword for the regulatory environment is NDFIs, non-depository financial institution loans. Yeah!
NDFIs.
Yeah, NDFIs. NDFIs are going to be all the rage in conversations from every regulator, whether you're a national association or you're your state chartered non-member bank, you're regulated by the FDIC, whatever you're regulated by, right? That is going to be what all banks are going to be looking at because they don't want to be responsible for not seeing something that they think is material weakness in the market. So whenever you think that it's, I think during the contagion period, it was any bank that had exposure to funds that were outside of the FDIC insurance, right? Unprotected funds. They were just looking at those accounts. So now this is the buzzword, NDFIs, non-depository financial institutions. Private credit funds. They don't take deposits in, and they're a financial institution. That is exactly what they're looking at. That is the buzzword right now. That is the shadow banking system where banks are really lending to them. Most of the money is coming from them, 87%, and now bank regulators are all over those loans. So JP Morgan Chase comes out. A lot of the larger banks come out.
They downgraded these loans.
They downgrade it. Why? Because they're getting regulatory pressure from the regulators that there's a weakness in this market. And we know from the Dodd-Frank conversation, Saied, you have to be proactive, not reactive to market weakness.
Right. Yeah. They have to be proactive about this, right? Versus like waiting for a situation to occur and then announce it.
So even though they don't have these loans directly, they're loaning to the funds that make the loans to the companies, these private companies. They still have an obligation to say, okay, if there is a risk of default here, I have to reserve proactively for losses that I think I am likely to take under these models. And that's exactly what the banks are doing now. Meanwhile, the narrative from private credit and the talking heads on CNBC is like, no, this isn't the same thing. It's good. Hey, bro, look, I'm in the business for a little bit. The banks are saying bullshit. Okay? As a matter of fact, the regulators are coming back saying, hey, bullshit. The banks are like, you're right. I'll reserve more against it because there's some losses here.
Yeah.
And you guys are like, nah, they'll be fine. I'm going to go ahead and take the bank's opinion on this one.
Right.
Because they actually have to do the analysis. They can't just, and here's the thing, you can't just arbitrarily move money because you say, hell, there's some narrative risk around this where it's going to move money. You actually have to do an accounting and finance and underwriting breakdown to make that determination because otherwise companies could manipulate their balance sheet if they're a publicly traded company.
Right.
Or their income statement. So they can pay lower taxes, for example.
And for a lot of these type of loans, are they reviewing these annually?
No, quarterly.
Quarterly.
Yeah, baby. They review these quarterly. Almost all of them are reviewed quarterly. Some cases monthly. So this is fresh data, baby. This is a freshie.
It's a freshie.
Yeah, you're getting a freshie. So the transparency, well, the banks in the great financial crisis had public pricing, right? They were all publicly priced. There was the CDOs, the synthetic mortgage-backed securities were traded with the QSIP as an active stock. So you saw it in real time. Unfortunately, the transparency in the private credit market is based off the net asset value, NAV, and it's very murky, right? The net asset value is more of an accounting thing, and it's determined, but it's not like it's a price you can see trading in real time. It's just one of those things that's determined from an accounting perspective based on the overall financial health of the company, which you got to get your income statement, your balance sheet, and someone's got to put a multiple on it, and those multiples can change dramatically. The same reason that private equities take companies public is they try to smash companies together or smush, right? And as they smush them together, they're going to say, okay, well, this company demands a higher multiple. So now instead of a company that's making, $2 million a year with a multiple of 3 being worth $6 million.
Yeah.
A company making $2 million a year with a multiple of 4 is now worth $8 million.
Right.
Well, that $2 million delta, that's the bread and butter of private equity.
Yeah.
Well, if those multiples are going down because there's weakness in the market, the economy's taking a hit, all of these investors are getting hit in the ding-ding, and these companies are likely to not get sold, which means that the private equity is left holding the bag.
Yeah.
Trust me, I'm not shedding a tear for private equity, but that's just how this plays out.
Yeah, and this doesn't just happen solely with private equity. This happens across the board, right? This is when companies can no longer qualify for their loans. What sometimes this is what they'll do. I think this is what Paramount's doing with Warner Brothers.
Damn right, baby. Damn right. Look at you.
Cerebral dog.
Just all up in here, cerebellum.
Cerebellum.
Did you go for the earth tone attire?
Yeah, you saw that?
Yeah,
the
all
under-
earth tones.
Yeah.
Kim Kardashian
It's very
would love
warm.
to be very all over that right
Very
now.
warm,
Does your
yeah.
wife know you stalk her page, or is this just that you just do the chocolate browns?
This is because it's Nike, bro. Skims is on Nike now. I can't avoid it. I mean, that's like
And look, I don't want to be this guy, but I don't dislike their products.
some of their stuff is out there.
You know how like I said that if you have a human connection and people know that you're real, that there's a connection to people and those brands do well.
Yeah.
If they remove Kim Kardashian from the Skims line, I would like it more.
Addition by subtraction.
Yeah, I think in some ways you need to, and I want to use harsh words here, divorce yourself from
Wow.
the situation.
Wow.
Yeah.
Christopher. That's a little insensitive.
It's not that I don't like her. I said that I don't like all the rhetoric around the brand.
Yeah.
Just give me the brand. You can keep the rhetoric. That's all I'm saying.
Louis
I have no problem with her.
I like Louis Hamilton. Why is Louis doing this?
See, and this is the problem, right? Like, I don't want Louis Hamilton to come into my underwear selection. You know what I mean? Like, I'm just saying, like, Louis, you stay over there.
Yeah.
You do you. I'm over here. I'm gonna do me.
Right.
And like, I
Let
don't
me just
need-
respect you from afar.
Yeah.
Why are you now doing this?
And look, I get it, Nike. Like earth tones, cool brand. The designs look good. I don't know about the split shoe thing. That's
Nike's hurting, man.
Yeah, man.
Nike's hurting. I think they were. Everyone was anticipating a Steph signing. I think he's going elsewhere.
Well, yeah, he's gonna do something. He's gonna try to do something big. I don't know that that's a
Anta.
good play for him.
Anta, yeah.
Yeah, I don't know that that's a good deal for him. But
You
that's,
guys have heard of the Kardashian curse, right?
Yep.
Which one?
Yeah.
All of them. So,
I do not co-sign this, by the way.
Well,
okay.
I take no part in this. I don't want no part of the curse.
So, doesn't Hamilton drive for Ferrari?
I think
Ferrari.
now for a long time it was Mercedes. Yeah.
Yeah.
It's been over 500 days since Ferrari's won Formula One.
What are you trying to say, Regil?
They're not the big.
It's
they're-
the Kardashian
The
curse.
Ferrari isn't the biggest player in the space, right? It's Red Bull, right?
Yeah. Red Bull's probably the biggest spender. I think.
Red Bull and Honda.
It's still up. They're still up there. Red Bull, Honda, Mercedes, Ferrari,
Haas.
McLaren. Haas, the booty killer? Bro, the worst part was that's my Pokemon Go name.
Yeah. I know.
Can you imagine pulling up to a Pokestop and some dude's named Haas the booty killer sitting there with
Come
his
on, man.
Charizard?
Kids reading this.
Mega
What is
Evolved.
that? Who's this?
Mom, what's Haas the booty killer?
What is a booty killer?
The best part was my son trying to tell somebody else what my username was. He's like, what does he mean by he kills booties? I'm like, no, it's like pirate's booty.
Yeah,
Like, I go, I'm
Lord.
going for all the gold, kids.
Yeah,
Yeah.
yeah. Come on now.
I had to play the Digital Underground song where the guy goes, you can call me Haas, the booty killer.
Mm.
Anyway, that's all. Yeah. Whatever happened to dude from Digital Underground?
I don't know.
Yeah. Regina, don't Google that.
No, no,
Yeah,
not going to.
don't do that.
Off
yeah.
the search engine.
Yeah, I don't want to do that. That was a
Oh no,
good
your
show.
AI is googling stuff.
Yeah, no.
I thought that was a really good show, really informative for everybody, and like a good positive spin as to how it makes everybody more informed.
It took me about 280 milligrams of caffeine to
get
get
there?
there, but yeah, I'm there. This new flavor, by the way, is not too bad. It's Punk Punch. That's me, baby. Punk punch.
Yeah, that's I don't know. If I'm cracking open an energy drink, I'm going to like something that's guaranteed it's going to deliver. I'm not trying new flavors.
Okay, so you stick to the same cheeks that you crack. I get it.
The cracking cheeks, dog. There wasn't enough love for that, by the way.
The clapping cheeks episode.
Clapping, cracking, yeah.
Yeah, I was gonna name the episode "Clapping Cheeks" to see what happened.
Yeah.
Somebody made a comment, and I'm not gonna name the username because it was heartfelt. That a lot of the titles have been throwing them off. They don't want to like listen to the episode because they're so negative. And I thought, well, then I'm just gonna start using like really obscure titles that aren't meant for SEO.
Let's make money.
Yeah. Crack them cheeks and make dollars.
Yeah. Make dollars while cracking cheeks.
Yeah. Yeah, I'm out here.
Listen, if you're listening or watching the show, please head over and leave us an honest 5-star review. If it's on YouTube, subscribe, hit that like button, ring that notification bell, do all the moist goody good stuff. If you really like the show, the best thank you that you could give us is to send this over to a friend, a family member, a colleague, another investor that you feel like could benefit from the show. And that will allow us to continue to create great content for everybody.
Yeah, you started a little bit there at the end. Let me just say, I know some of you guys listen to the show, you don't subscribe. Want to know how I know? Some of you assholes that I talk to like on a regular basis will tell me like, "Oh, that was great in the last episode." I'm like, "This motherfucker ain't subscribed. I know you're not subscribed.
Yeah, man.
I know you never commented."
The analytics say a good portion of the listeners that come back over and over are not subscribed. Subscribe to the show. I mean,
like 75%.
Yeah, you plugged in. Come on now.
Oh, hey, I didn't tell you guys. Our syndication platform got approved to be day one launch on Apple for the video on Apple Podcasts.
That's not for everybody.
That's not for everybody. So we are going to be launching on Apple Podcast in the spring here, which is where we're in, video on Apple Podcast. So if you're watching us on Apple Podcast, you'll have the ability to switch. Now, it's a different format. Unlike all the other platforms out there, Apple's got to be unique. It actually streams a little bit differently, but we're 100% ready to go day one for Apple video launch.
Gucci.
Yeah, I just got that email this morning.
Gang.
Yeah. So I'm
That's a big thank you to all the listeners.
Yeah. Shout out to the homies.
Yeah. Shout out. Virgil, you got anything?
No, just have a great day, guys. Thanks for listening.
Yeah.
Aww, I love him so
Teddy
much.
Teddy bear. Yeah, Christopher?
He's so nice.
Yeah, you got a son to go pick up.
I do.
Yeah. All right.
Oh, yeah.
Good night, everybody.
Okay, bye.
Good afternoon.
I held it long.
Yeah.
Yeah.